Right. Welcome back, everybody. I hope you've been had your energy levels and caffeine recharged by the break. Our head of comms told me to remind you that if you haven't got enough pay fun today, there should have been flyers out while you were having your coffee advertising some work we're publishing next week on earnings volatility, showing using data from people's current accounts, not yours, I promise, to see how their earnings change month to month, which no one has ever done in the UK before. So come along to that next week if you don't. But if today is enough for you, then the next session is hearing from Jason Furman about his take on what is driving their version of the pay crisis as discussed in the United States, touching on the comparison with the UK. Jason, I'm sure all of you know, but is the Professor of Economic Policy in Practice at Harvard University and a visiting fellow at the Peterson Institute, which is an excellent think tank in Washington, focusing on a huge wide range of issues. Was probably leading a lot of the serious thinking in Washington at the moment on economic policy making. Before that, Jason was the chair of President Obama's Council of Economic Advisors, and both since and in the White House led a lot of the debate in the US about some of the issues we've touched on today. Labour market power, where it resides, the relationship between productivity and pay growth, all those kind of issues. So with lots of welcome to Jason. Thank you for coming. Over to you, Jason.
Thank you for having me here. I just flew in this morning so I could share this wisdom with all of you, and that's just by way of setting a low bar for any wisdom that I do have to share. Probably no issue has created more puzzlement than what is often called the wage puzzle in the United States. And part of why it's puzzling is that different people have different definitions of just what the wage puzzle is. So what I'm going to try to do is define two versions of the wage puzzle, solve one of them for you, and speculate about the other, and then draw some links to what you've experienced and seen here in the UK. There are dozens and dozens of different measures of wages, compensation, different splits, different parts of the economy, et cetera. I put a lot of them up there in gray. Goldman Sachs does something that is a principal component analysis, basically a weighted average of them, gives you that orange line. A lot of what I'm going to focus on is the micro data and look at workers aged 25 to 54, because that abstracts from some of the demographic effects, because a couple tenths of the slow wage growth is simply that there is more workers going into retirement as the baby boom goes to the retirement boom. That's not as much interest for this purpose. I'll define wage puzzle number one as why is wage growth slower today than in the late 1990s. The late 1990s for the US economy is the canonical hot economy. And the sort of folk wisdom is that the unemployment rate stayed low, around 4% for a sustained period of time, that drove really rapid wage growth, and that's proof of what a hot economy can do for labor markets. And the fact that we are operating 1.2 percentage points below it in terms of wage growth today suggests that we're not nearly as hot an economy as we were in the late 1990s. That's the sort of canonical, conventional story that you hear all the time. Now let's unpack it and go through a few different hypotheses. The first hypothesis is inflation. Inflation this year is quite high, but actually trend inflation has been lower than it was in the late 1990s. If you look at something like core, taking out energy and food, you look at inflation expectations, or even just average over the last 3 years, which is what I've done in this figure. And if you do that, it explains a part of the difference from the late 1990s. About a third of it is simply that when inflation expectations are lower, nominal wage growth is lower, and that's not something we really need to worry about very much because all we care about is real wage growth. That still leaves 0.8 of a percentage point of slowdown that we'd want to explain. The next hypothesis that's gotten a lot of attention is inequality bargaining power of workers at the bottom, monopsony in labor markets, no poaching agreements, non-compete agreements, and a whole bunch of things that have an increased concentration of businesses that have stacked the deck against workers. I think all of that's quite real. I think all of that's important. I've written a lot about all of that. The question is it a surprise? If we're surprised about how slow growth is, and we're trying to compare growth to the late 1990s, it can't just be the case that all of those are a problem. It has to be that all of those are a bigger problem now than they were in the late 1990s. And what's the evidence on that? This is wage growth by quintile in the late 1990s, nominal wage growth. And this is, real wage growth. This is wage growth, the orange bars, in the last 3 years. And if you look at those orange bars, you see something pretty remarkable. First, you see that the single fastest growth of any quintile in the last 3 years has been the bottom 20%. You see this in a variety of data sets. They're the people who are getting the biggest wage increases, and they're getting much bigger wage increases than they were in the late 1990s. In contrast, the big difference, big reason that wage growth was a lot stronger in the late 1990s was actually the top fifth of workers were growing very quickly. Now, I don't want to put that up there to say, inequality is just solving itself naturally. Part of why we've seen that is in the United States, while the federal government hasn't raised the minimum wage, 24 different states in the District of Columbia have raised their minimum wages over the last couple of years. So part of what you're seeing there is the result of active efforts to raise wages by low-income workers. More broadly, if you look at inequality, the top 1% share has been steadily rising. It's very cyclical and noisy around it, so sometimes the trends can be hard to discern. There's some evidence that it's growing a little bit more slowly since the year 2000 than it was before, and that's certainly what you see for CEO to worker compensation, where in the late 90s it shot up from about 100 to 300 to 1, and it's bounced around there since then. So again, a lot of the differences in wages between now and late 1990s are more at the top, where CEO pay was skyrocketing then. It's rising now, but not skyrocketing in the same type of way. Third hypothesis, which has gotten a lot of attention, is slack. There's a lot of different ways to measure slack. The short-term unemployment rate actually fits and explains inflation and wage inflation quite well, in some ways better than these other measures statistically. It's a very narrow measure that says if you've been unemployed for more than 26 weeks, you're not exerting any downward pressure on wages. That's considerably better than it was in the late 1990s. Sorry, this is actually the wrong slide here. So don't look at it. But it's considerably better than it was in the late 1990s. The regular unemployment rate is also better than it was in the late 1990s. The one measure that is worse than it was in the late 1990s is the employment population rate, the percentage of 25 to 54-year-olds who are working. That's much lower than it was in the year 2000. People who argue for slack as explaining this phenomenon, they point to that. I'm pretty skeptical of that because that's a measure that performs really poorly over medium and long periods of time because it's affected by so many factors other than just the cyclical state of the economy. So if you look on the left-hand side there, that's men aged 25 to 54. Their employment rate has been falling since the 1950s. And so if you looked at that, you would think, for example, that in the year 2000, you'd think the economy had a ton of slack compared to what it had in 1979. I don't think that would be the right inference. It would just be a lot of men had withdrawn from the workforce for structural reasons that doesn't affect inflation in the same way. Similarly, if you looked at women in the depths of the recession in the early 1980s, you had more women working than were working in the 1950s. That tells you about cultural and institutional changes about women's work, not about the business cycle. So this isn't a very good measure of the business cycle. It's one that can perform well statistically for short periods of time and quite poorly for long periods of time. So inflation explains part of it. Inequality goes the other way in explaining the pay puzzle. Slack, I think, doesn't explain it. So what does? Something you all, I think, have talked a lot about this morning. It gets less attention in the US conversation, which is just simply that productivity growth is a lot lower than what it was. It was growing at nearly 3% in the late 1990s. It's growing at 1% now. All else being equal, you would expect wages to grow about 2 percentage points less than they were back then. There's a lot of debate about the question of whether productivity is tied to wage growth. The answer in the academic literature is that it very clearly is, plus or minus something, call it 20%. So you have strong unions, you can get productivity plus. You have weak unions or a low minimum wage, you can get productivity minus, but you're still anchored around something like productivity. And that plus or minus hasn't been changing that much in the economy as much as productivity has. This is a famous chart that shows that purports to show the opposite of this. Productivity going way up, median compensation being flat. Part of why this chart looks this way is that there's a lot of methodological differences between the two lines, which part of the economy they cover, which price deflator is used for them, whether it's a mean or a median. You correct those, and the two move very close to each other, consistent with both the microeconomic evidence of the importance of productivity for wage, as well as a recent macro paper by Anna Stansberry and Larry Summers. Now wage puzzle 2. Why hasn't wage growth picked up in the last 3 years? Wage growth was, it's picked up a little bit, but not very much. It's been pretty strong in the last few months, so maybe we'll stop talking about this. Inflation doesn't help explain this. In fact, inflation has picked up almost as much as wage growth over the last 3 years, so that real wages have gone up even less than headline nominal wages. Slack, now it is the correct picture, doesn't explain this because no matter what measure of slack you prefer, the economy is much, much tighter now than 3 years ago. And in fact, if you weren't convinced by what I said by EPOP before, EPOP has fallen even more than other measures of slack. And so if you believe in EPOP as your model, you would predict even faster wage growth over the last couple of years than we've seen. So EPOP actually doesn't help explain the second wage puzzle. It compounds the mystery around the second wage puzzle. And it's important to remember that with slack, what matters is fuller employment, not full employment. So it's not like you get below 0 and your wages jump up. It's that for each percentage point your economy is tighter, your wages will grow a little bit faster. Can productivity explain wage puzzle 2? This is more speculative, but I think it can. And I think it can because it took us a while to believe that productivity growth had slowed. These are long-run forecasts done every year from 2000 to the present, each time for over the period of the next decade. And it took forecasters a long time to downgrade their expectations of productivity growth. And as that's happening, that could downgrade trend wage growth. So you have less slack, it's making wage growth go up. People getting more pessimistic or more realistic about productivity, making wage growth down, and those roughly cancel out. So in summary, productivity is definitely the big story compared to the late 1990s. It could also be the story, insofar as we're slowly realizing it, as to what's keeping wage growth down over the last couple of years. Slack, I don't think explains the longer term. It definitely doesn't explain what we've seen more recently. And inequality is a big underlying issue here. It's just not changing in a way that would lead to this. So to conclude by comparing to the UK, in the UK, just using the same comparable thing, the wage slowdown relative to the late 1990s is 2.9 percentage points instead of the 1.2 I was talking about for the United States. In wage puzzle number 2, it's quite similar in the UK as it is in the United States. The slowdown in real wages is even larger in the UK because your inflation actually has gone up rather than come down. So the thing that was 0.8 in the United States in terms of the real wage slowdown relative to the United States is 3.5 in the UK. So it's much, much bigger slowdown in real wage growth here than anything I've talked about in the United States. Slack definitely doesn't explain this difference because you've had much better performing labor markets in terms of employment rates than we have, with your prime age non-employment rate, the opposite of the employment rate, down. So that's a measure of slack, down, up in the United States. Productivity growth, as you all know, has been weaker here than the United States. And so in looking at least casually at this comparison, I draw a few conclusions. One, the wage slowdown is much larger in the UK than in the United States. It's not well explained by slack or demand. The UK has had bigger increases in employment rates. That's not to say there couldn't be more demand here, that wouldn't help solve the problem. That just doesn't explain the difference from the United States. A scary hypothesis is that some of the difference is explained by supply. For whatever reason, a set of structural policies in the UK have increased employment growth that puts people who are less productive into the workforce, lowers productivity growth, lowers pay growth, and so you get this terrible choice between high employment rates that you have in the UK with low wages or low employment but higher wages that you have in the United States. I certainly don't think that's the entire story. I'm sort of more of an optimist than that, but that's something scary to think about. And finally, productivity matters a lot in both countries, but the productivity slowdown in the UK isn't large enough to explain that even larger shortfall in wages than you've seen in the United States. Thank you.